Attention, this is absolutely insane. Raoul Pal ruthlessly exposes why buying a house or investing in real estate doesn't build wealth, but often destroys it. Many people are blinded by the old illusion, but he also shows how we can actually create real wealth right now, in these times. Let's dive right in. Many people who are investing in real estate now are forgetting one crucial thing. They're building on past performance, on the past returns of real estate. In the past, however, real estate was actually a solid deal. For example, houses only cost about 3 times your annual income and you could pay off the mortgage in just a few years. But today, back then it basically felt safe and the value often increased over time. But today, the reality is brutally different. Mortgages are gigantic compared to income, often 5 to 10 times as much or even far more. You basically spend your entire life paying them off. And if something goes wrong, like losing your job or a crisis, the bank simply swoops in and takes the property. You no longer have any real control. And that's why Raoul Pal doesn't consider a house a real investment or asset that you sell or make a profit from. Instead, according to Raoul Pal, it's a lifestyle bank. You pour money into it for security, comfort, and a good feeling, but you almost never get it back out. Maybe you'll downsize when you're older, if there's really no other way.
People think of houses as an asset, but in the end, you almost never actually sell your house to get the money out. You might downsize later in life. If it's absolutely necessary, you might sell it. But generally speaking, your house is the lifestyle bank. Now, that is super important. And I think it's the most important trade of assets, the lifestyle bank. So what is all this for? You want a certain lifestyle. So do you sacrifice your future self having more money by buying a house and getting security earlier? I would argue those days are over.
What do you mean?
Well, I could do it because it was 3 times my income.
Yeah.
So a house wasn't expensive for me. So I could start paying it off a bit sooner, and it wasn't a big deal. But now, your mortgage is likely a huge amount compared to your income. You'll spend the rest of your life paying it off. And most of the time, you're just paying off the interest. So you're not actually getting anywhere. You don't own that house. If anything goes wrong, the bank takes it away from you. So you need to get more control over your life. And that comes from having savings that are growing.
According to Raoul Pal, the days when a house was a smart choice are over. It's a trap that millions don't see. Instead, Raoul Pal advises, save money and let it grow. Invest in things that bring real returns, like stocks, crypto, Bitcoin, or tech. And this is where it gets interesting. Raoul Pal sees the current financial market as being like 2017, but now on steroids.
This is an extremely accelerated easing of financial conditions that is currently taking place, driving both M2 and the dollar. I don't know if this will make the whole thing more powerful or just different. I mean, it's hard to be even more powerful than 2017, but that was the early adoption phase in the crypto space. But technology, well, I don't know. It just feels like 2017 on steroids.
Back then, it was a huge cycle for assets with the early crypto boom and tech growth. And today, a super fast loosening of financial conditions with skyrocketing M2 growth, that is, the money supply and a weaker dollar, is driving everything even more extremely. That's why Raoul Pal is wondering whether this speed is making it more powerful than ever before. According to him, crypto was still in its infancy in 2017, tech was uncertain, but now it could explode and create real freedom, financial freedom. And before we continue, like the video, and if you want to store your Bitcoin and crypto securely, you'll find more information in the description below the video. And now, Raoul Pal shares more details in an interview. Gold is the ideal real-time indicator for financial conditions to see the state of the financial system, whether credit, interest rates, and money flow are loose or tight, and so on. Gold reacts more sensitively than statistical models. Gold responds directly to currency devaluation and, of course, to monetary policy easing. According to Raoul Pal's model, gold rises first as a sensitive real-time indicator for looser financial conditions, such as a falling dollar or increased liquidity. Gold signals the start of this chain. Then, with a delay, the rest follows like the M2 money supply. With a 3-month delay, assets such as Bitcoin or tech stocks follow. 9 months later comes the ISM index, which measures US industrial activity, and then the full economic upswing.
What we have found is that there is a nice phase shift between the financial conditions, which lead everything else. And here's a trick for anyone who can't calculate financial conditions. We use a regression between the dollar, bond yields, and the main industrial commodities. But actually, a study we did recently really surprised us. Gold reflects financial conditions in real time. Everyone wonders, what actually drives the price of gold? Suddenly, when we saw this chart, Julie and I said, something I think something. And in fact, gold leads everything because it reflects current financial conditions, which kind of makes sense, right? It is the most sensitive to financial conditions. Then comes the movement in liquidity and in the markets, and the ISM more or less follows that. So there's a nice way to look at things to get a better understanding. So we all know, actually, by now, everyone on Twitter knows that global M2 leads crypto by about 5 to 3 months. This chart will be our downfall. We know that.
You've created a cult.
And it will break. It will also fall apart at some point. And then
Yeah.
we're all the worst people in the world, even when we try to tell people. So we have financial conditions, then we have M2, then we have markets, ISM. So you get a good understanding of where this is heading and can predict things because, again, there's a dominant factor that's just so simple. I remember that I used to have to figure out all the variables that influence Brazilian interest rates, and BRLI, nobody cared about it. It's like
Yeah.
factor in, factor out. That's it. A game. I think what
I mean, I think the point is that we really try to break all of this down simply. What Raoul is saying is true. Gold is, as you know, essentially the opposite of financial conditions, mainly because financial conditions are a function of the dollar. So you have that, then you have global M2, which lags by 3 months. And then again, 3 months later, you have things like Bitcoin, tech stocks, and the yield curve, right? So it's actually also a function of the yield curve. Then, you go back again, whatever. I mean, financial conditions lead the ISM by 9 months. And then let's just say the ISM is at T equals 0. What people don't understand is that there's the sequence we call the dominoes of the business cycle. So then, at -1 month, you're talking about things like hours worked, so growth and overtime. At -2 months, for example, it's capital goods orders, durable goods orders. At 3 months compared to the ISM, as we know, it's things like GDP, industrial production. At 4 months, cyclical employment growth. At 5 months, unemployment. At 6 months, the consumer price index, CPI. Then you really get to what I call the caboose of the business cycle train, wage growth and rent inflation. And there are these kinds of domino sequences with inflation as well. For example, commodity inflation leads to goods inflation, which in turn leads to services inflation. It's simple once you understand that you can break everything down to it and say, okay, these are the things I should really focus on if I'm trying to predict the business cycle as accurately as possible. And that's part of the reason why we somewhat arrogantly called it the everything code, because right now it kind of explains everything. And that's not to say that this code of the markets has always been the code. It's just what it is, And all of this is pretty, relatively predictable. You're always going to make mistakes, all those things. But in general, it's a completely different environment than most people are used to. Yeah, and I mean, if we just get to the point, because you have this chart about the dollar that we've shared a few times, you've probably already seen it. Because, I mean, a big part of why this year has played out the way it has is that it looks very similar to 2017, right? When the dollar surged in the fourth quarter and then dropped again. And we can see that this time it has even accelerated further, which of course leads to the fact that since the dollar rose in the fourth quarter of 2017, we had economic growth in the first half of 2017, which is also what happened this time, right? We saw that Citibank's economic surprises have declined, and that's a key reason why technology stocks and things like crypto corrected in the first quarter. But then in the second half of the year, given the easing of financial conditions back then, as well as now in the first quarter, the foundation was laid for economic data to exceed consensus expectations. I mean, just look at bond yields. You see, people are, and that's exactly why we can actually talk about the cycle for a moment. Bond yields are really interesting because people say, well, interest rates are too high. They're too high. And, the Fed knows that. Everyone knows that. And I mean, for the everything code to really be the everything code, they have to come down. But what we've been saying all along is that as long as interest rates don't rise significantly from here and stay within a certain range, like they've done so far. So this year and also back in 2017. In fact, at the end of 2017, they started at around 2 to 2.5%, right? Because the most important offset back then was that, according to this chart, the dollar depreciated so much. So the point is that, but there was something, well, in 2017, they did a kind of balance sheet reduction. Well, they continued to raise interest rates in 2017. And then in the second half of the year, they did quantitative tightening. All the liquidity in 2017 came from the ECB and from China. But overall, financial conditions eased because the dollar fell. And if you look at these charts that cover the same period, global M2 exploded, right? It feels eerily similar. I mean, that's bizarrely good. It fits bizarrely well. Yeah. I mean, and I've used the same time frame for all the charts. And, Felix, with the weakness in the first quarter that you saw, I'm sure you also saw a lot from the big strategists. Felix, to return to the question you asked earlier. Look, here's something interesting, because as we know, 2017 was a major cycle for assets.
Yes.
Does the speed of M2 make a difference or not? The question is, what ultimately tips the scale for the final devaluation? Because this is an extremely accelerated easing of financial conditions that's driving M2 and the dollar. I don't know if that will make the whole thing more powerful or different. I mean, it's hard to be more powerful than 2017, but that was the early adoption phase in the crypto space. But technology, well, I don't know, but it just seems like 2017 on steroids.
That's Raoul Pal's model. Everything depends on liquidity, meaning how much money is available, and today it's similar to 2017, but according to Raoul Pal, much more intense. Back then, the dollar rose at the end of 2016, which loosened financial conditions, boosted the M2 money supply, and as said so, wealth exploded. And Bitcoin exploded from $1,000 per Bitcoin to nearly $20,000 per Bitcoin. That was a 20-fold increase. Now just imagine if that happens again. That would bring us into price ranges like those predicted by Larry Fink from BlackRock, namely a Bitcoin price of $700,000 per Bitcoin, or the former CEO of Binance, who even expects between $500,000 and $1 million per Bitcoin. And according to Raoul Pal, we are now at a real turning point in terms of liquidity and in the global economic cycle. According to Raoul Pal, the usual 4-year market cycle is stretching out. Due to post-pandemic issues and the aggressive monetary policy of 2021, the crypto bull run was abruptly halted when market liquidity peaked in March. Then, in 2022, central banks everywhere tightened simultaneously and the economic cycle reversed. And today, it's the other way around. Liquidity is accelerating, financial conditions are easing, and indicators like the ISM are rising. And when the ISM climbs above 50, which we're seeing right now, and heads towards 60, according to Raoul Pal, that's when the big jumps in risk assets happen. That's the so-called banana zone where profits explode and generational wealth is built. This will be especially true for crypto. Bitcoin has already risen over 600% since 2022, but according to Raoul Pal, the next phase of the banana zone with more altcoins and institutional money is still to come. It's similar to 2017, but this time everything is bigger and more institutional. Raoul Pal continues to believe that demand will become massive. Stablecoins could also reach trillions in volume. Raoul Pal estimates that in 6 to 8 years, crypto will reach 100 trillion as an asset class. And if liquidity remains as it is, that could happen much faster, and we're right in the middle of it now. So that means, act now. And if you enjoyed the video, like and share it. I wish you a great day and see you soon.